Hey, it's Matt Decker with Leverage Wealth Management. This is the second video in a series of videos on cash value life insurance. If you haven't watched the introductory video to this series, make sure you check that out first. I will link it up above. It's only 5 minutes long and it just kind of lays the groundwork for what we're going to be talking about over the next several videos. This specifically is going to be all about variable universal life insurance, also known as variable UL or VUL. And if you remember from last time, we talked about cash value life insurance on a risk reward line. So if you have least risky to most risky, and VUL was on the far right hand side of our risk reward line. And so there's really a few things that I want to talk about specifically as it relates to variable universal life insurance contracts, and I'll show you what one looks like in a little bit here. But really I want to start with a fundamental concept of all universal life insurance policies. So this is how every universal life insurance policy is going to work, and it's all about how they determine their fees. Now, if you look up universal life insurance on the internet, if you hear people talk about it on the radio, even if you're looking on YouTube, what you will find and what you will hear is that a lot of people will say universal life is bad because it's backed by something called ART, which stands for annually renewable term. And so when they're talking about annually renewable term, the reason that they don't like it is because each year your term insurance cost is going to go up. At least that's what they tell you. You don't want universal life because every single year the cost of the term insurance inside the contract is going to go up because it's based on your new age. So if you're a 50-year-old, year one, your term insurance cost is based on a 50-year-old age. Year two, it's based on a 51-year-old, then a 52-year-old, then a 53-year-old, so on and so forth. And if you know anything about term insurance, every single year, term insurance gets more expensive. If you try to buy term insurance every single year, you'll pay more money with each policy that you buy because you're older. That's how term insurance works. That is actually somewhat of a half-truth because while it's true that these policies are priced using annually renewable term insurance, that's true. What they don't tell you is that it's only half of the equation in determining the costs and the fees behind your life insurance. So the equation goes something like this. First, they're going to take your death benefit, okay? And then they're going to subtract out your cash value. That is called the net amount at risk. And your net amount at risk is actually what's determining the annually renewable term rates. So when it comes to universal life insurance, you are only paying for the fees associated with life insurance based on your net amount at risk. So people like to say things like, you don't want universal life, any kind of universal life, because your fees go up every single year. And conceptually, that feels like it would be true. But think about it this way. Let's assume that your death benefit is $1 million for the life of the contract. So you got $1 million life insurance policy, and let's say you're 50 years old, and it goes to 120 years old. So for all this time, you've got $1 million life insurance policy. But let's also assume that you have a cash value life insurance policy. And this could be any type of life insurance policy. Well, it'd have to be a universal life insurance contract. So any type of universal life insurance contract. Your cash value is going to grow over time. And so what's happening here is your net amount at risk is actually getting smaller and smaller and smaller and smaller and smaller until it starts to run right alongside your death benefit. And when you see this line get basically equidistant from here to here, that's called reaching corridor. You are not going to be able to get any closer between your cash value and your death benefit. That's known as corridor, okay? When you hit corridor, your policy is as efficient as it can possibly be. That's probably a whole nother conversation. It's a little bit more than I wanted to get into here. But the purpose of this illustration here is that this shaded area in between, that's your net amount at risk. And what's happening to your net amount at risk? Over time, as your cash grows, your net amount at risk gets smaller and smaller. So you have annually renewable term insurance, which increases over time, and you have your net amount at risk that decreases over time. Let's say it another way. Every single year, you're paying more for every dollar of insurance that you're buying, but every single year, you're buying less and less dollars of insurance. And so what you're left with in universal life insurance, if it's structured the right way, okay, it has to be structured the right way. It could be structured the wrong way, and this could get way out of whack and be really ugly for you. But if it's structured the right way, what you should see is your fees look something like this. They generally go up over time, but it's not a straight linear line up. And actually, you have some years where you're paying less fees than the year before. That's what it should look like. And then you'll get to a point out here where you hit corridor and your fees stay pretty constant. Okay, that's what fees inside a universal life insurance contract should look like if it's done the right way. So we spent a little bit of time on that annually renewable term backed the universal life insurance contract, and the fees are based on net amount at risk. We spent time there because that actually foreshadows every single type of universal life insurance contract. So it's important that you understand how they work. Now let me get into the 3 things about variable universal life that I think are probably the most important 3 things about it. 1 of them is good, 2 of them are bad. So variable universal life has unlimited upside, okay? It is linked to the stock market. In fact, it's linked via mutual funds and sub-accounts. So if you've ever heard of things like American funds, Vanguard funds, Fidelity funds, most variable UL policies have those options in what's known as a sub-account. So your money goes in, and then it gets invested via those different sub-accounts and via those different mutual funds. So that means you've got unlimited upside. This is the only life insurance contract that exists that has unlimited upside. I've seen variable universal life contracts with huge returns from year to year. It happens, okay? Unlimited upside. If you catch a bull market, you should hope to capture the majority of the bull market. So that's the good. Let's talk about the 2 negatives as it relates to VUL. The biggest one is fees. Because although you have this unlimited upside, the fees associated with a variable universal life insurance policy are pretty hefty because there's a lot of them. Not only do you have your cost of insurance, okay, COI, cost of insurance, you also have admin fees. You also have per unit charges. You also have fund fees, and those come in 2 forms, and you're familiar with those if you've invested in mutual funds, but those could be anywhere from, let's call it 5 basis points all the way up to 125 basis points. And you also have premium loads. So all the fees normally associated with life insurance, plus this big one right here, which can make this policy extremely expensive if it's done the wrong way, okay? So unlimited upside is the positive. Fees, to me, is a big downside in the variable universal life insurance contract. Closely related to fees, and the thing that probably gets out of control the quickest, is how the fees are determined. Because remember, we're talking about universal life insurance, which is basically determined by your net amount at risk. Okay, that's the thing, the net amount at risk, that's the thing that is determining how much you pay in terms of cost of insurance. Let me pull up a policy and show you exactly why I'm concerned about this net amount at risk in a variable universal life contract. So what you're looking at here is the ledger page of a variable universal life insurance contract. And what I want to try to do is make this as simple as possible to conceptualize. So remember, the thing that we're going to key in on is net amount at risk and cost of insurance. So our net amount at risk is going to be this column here, cash value, minus our death benefit column. So column 4 minus column 5, that equals our net amount at risk. So you can see early on, we've got a huge net amount at risk because we don't have much in cash. Later on down the road, we have much less in terms of a gap between our cash and our death benefit. So the amount of insurance that we're buying for these first 20 years should actually be going down every single year, which should help us in terms of paying fees. But remember, this is a variable universal life insurance contract, unlimited upside, unlimited downside. So I want to go through an exercise that just shows you what can happen in these VUL policies. I call it the VUL death spiral. So let's key in on year 20, age 69, and let's just subtract across. So 1.377 minus 1.655, that gives us negative $277,000 in change, which means we're buying $277,000 of insurance in year 20. So far, so good. Obviously, $277,000 here is much less than the $980,000 we were buying up here. But again, variable universal life insurance contract, unlimited upside, unlimited downside. So what happens if in year 20 the market corrects by 30%? Okay, well, what happens is your $1.3 million is going to get reduced by 30%. So let's do a little bit of math. $1.3 million times 0.7 is going to equal $964,000. So if our new cash value after a 30% drawdown or a 30% pullback is $964,000, well, now we have to recalculate our net amount at risk. So let's do it again. $964,000 minus, we're still buying the same 1.6 million. 1.6 million equals around $690,000 as our net amount at risk. Well, $690,000 divided by $277,000 is about 2.5 times. So that means we're paying 2.5 times more in fees in that 1 year because our net amount at risk almost tripled. Now it gets worse. Have you ever heard of something called dollar cost averaging? Dollar cost averaging is pretty simple. I'm sure you've heard of it. Essentially, it goes something like this. If you put in the same $10,000 a year into the same stock, over time, you're going to buy more shares of stock at a lower price. Because when the stock, let's say it's Ford stock, when Ford stock is at $10 and you put in your $1,000, you bought 100 shares. When Ford stock goes to $5, you put in your $1,000, you got 200 shares. So you put in the same amount of dollars, but you got twice as many shares. Okay, well, that's dollar cost averaging. Over time, as the market ebbs and flows, you'll end up buying more shares when the market's down versus when the market's up. And therefore, it brings your average price per share down. Okay, that's dollar cost averaging working for you. This is dollar cost averaging working against you because remember, fees still have to come out of this policy. And you'll notice we are not paying any more premiums in these later years, which means the fees have to come out of your cash account. Well, if your cash account just went from 1.3 million down to $964,000, guess what? You have to sell more shares in order to cover the fees associated with the life insurance in this particular year. And then when the market rebounds, you have less shares participating in the market, catching the rebound. And I like to call that the VUL death spiral because it starts to get out of control really quickly. Now let's slow down. Don't freak out. For any of you people that have variable universal life insurance contracts out there, it'll be okay. If you've had a variable universal life insurance policy for the last, say, 8 to 10 years, you have benefited immensely from the one thing that makes variable universal life attractive, and that is the unlimited upside potential of the VUL. Because you just caught a huge bull market that lasted for the last 10 years. So here's what I'll submit to you. If you have a variable universal life insurance contract, or if you're thinking about getting a universal life insurance contract, I want you to look at this chart and I want you to look at where we are now versus where we've been the last 10 years. And I want you to ask yourself this question. Going forward, Is it likely that your variable universal life insurance contract performs better than the last 10 years? The same as the last 10 years? Or worse than the last 10 years? Ask yourself that question. You've got a variable universal life insurance contract. Is it likely that your variable policy performs better, performs the same, or worse than it performed the last 10 years from a low of 2008 all the way to where we are now? If you can answer that question, hopefully it gives you an idea of what you should be looking to do with this variable universal life insurance policy in the future. So just to recap the things that we talked about, variable universal life is backed by mostly mutual funds, and you pay fees associated with those mutual funds. Your cost of insurance is based on the net amount at risk. You have unlimited upside. You also have unlimited downside. And because you have unlimited downside, it can cause your net amount at risk to skyrocket in later years when the market drops, causing your fees to also skyrocket in later years when the market drops. Selling more shares to cover the costs associated with the fees, having less shares participating in rebounds. And the question that you should be asking yourself if you have a variable universal life insurance policy is, will my VUL perform better or worse than the last 10 years? And if you can answer that question and you need some guidance with what you should do with your policy, you can always contact me on my email, matt@leveragedwm.com, or you can go to our website at leveragedwm.com/contact-us, fill out the form, and drop me a line that way. I look forward to talking with you in these upcoming videos, looking at index universal life, and whole life. Talk to you soon.